I mean, if they're being responsible, just to be honest, I mean, we have to put those fees on there if they can be charged. And it's always a lot easier to take away.
Someone had to ask. I'm Amy Viaclia, and this show is built on one idea that good questions asked of the right people make all the difference. Each episode, I sit down with someone who has the expertise most of us don't and ask the questions you might not know to ask. Someone had to ask, so I did. Today, we're talking about a number that shows up near the very end of the process. And for a lot of people, it's the first time the whole transaction starts to feel real in a different way. You've found the house, you've locked your rate, you've made it through inspections and negotiations, and then someone hands you an estimate of closing costs. And suddenly there's a number on the page that you weren't necessarily expecting or didn't fully understand was coming. What's actually in that number? Why does it sometimes feel like it appears out of nowhere? And is there anything a borrower can do earlier in the process to avoid being surprised by it? Jay Sills from Barrett Financial is with us today, and he sees this moment with almost every client he works with. So I wanted to ask him to walk us through it. Jay, welcome back to Someone Had to Ask.
Thanks for having me.
Jay, when someone sees an estimate of closing costs for the first time, what's actually in that number? What are we talking about?
Okay, so closing costs, that's the nuts and bolts of every loan. And that's where everything gets real. That's where whenever someone finds a home, they fall in love with the home, they can't wait to buy it, they're so happy that they're approved to buy the home. What happens next is your loan officer, me, will put together a loan estimate. And that's where all the figures get put together. And it's divided out into sections. And it starts, you can start on the top left of the loan estimate in section A. That's the lender fees. Those that area is where the one area on a loan estimate that can vary from lender to lender. That's the most important part to look at if you're getting loan estimates or rate. You're shopping for a mortgage with multiple banks, mortgage companies. The top left in section A is in my opinion, the most important because that's the only area that's going to vary in cost. And those are origination costs, discount points, processing, lender fees. So you want to look there. Now, the next section down in section B, that's services that you cannot shop for. That's where your credit report, the cost, and every bank and lender, we can only charge what that cost is. You're not being charged more. Whenever you see a credit report fee of $93, that's the cost that we typically pay up front. And see another example, an appraisal. You can't shop for that. We have to order the appraisal. And another thing that comes up. The buyer will ask, or am I supposed to order the appraisal? No, the bank does. We always order it because it has to be in our name, and we have to go through a third party called an AMC. That stands for Appraisal Management Company. So we have to go through a third party. We order the appraisal, and that comes with a cost, typically around $650 at the max. Let's see, a VOE charge. Whenever we send out verification of employment requests, sometimes we get charged. If I can get one automated online through who we use, it costs $68. That's the cost. So you're not being charged. You cannot be charged for more than what it is. So those are a few examples of what you cannot shop for. And that's why there's part of the cost that would be the same with me or any other bank. The next section, services you can shop for, that's section C. That's title fees. You can choose the title company or attorney's office to do the title work. Most people don't care. And my advice there is they're all going to be within a couple $100 of each other. If you know an attorney that you want me to use, it doesn't matter to me. But who I use is it's going to be about the same. They're going to be within $100 to $300. But those are services you can shop for. The next section, that's the right side of the loan estimate. Those are your prepaid items, your homeowners insurance, your property taxes and insurance escrow accounts set up because we have to take X amount of months to have that put in an escrow account. So whenever those your homeowners insurance and taxes become due each year, we have enough money in that account to disperse for you. So that's an is what it is cost there. So it's not going to be any different if you go with me or anybody else. So that's a rough breakdown of these sections of what makes up closing costs.
Of everything in that estimate, in your experience, what tends to surprise people the most? That line item that they didn't expect or they didn't even know to ask about.
Yeah. So the one thing that always pops up is homeowners insurance. There's a one and a two answer here. Number one, homeowners insurance almost every time. Homeowners insurance has to be paid up front for the year upcoming. So that's always a cost, especially first time home buyers. Don't realize that, okay, my homeowner's insurance for the year is going to be $1,500. Okay. But that $1,500 goes in, that's part of their closing costs with everything else. And that's who they choose. We don't choose insurance companies for anyone. It's up to you. We can always refer. I can always, I have relationships with a couple of different insurance companies, and I can help. Any loan officer can. But that's really the one thing that pops up, like has to be paid up front, and then always like, why if I'm paying on it monthly? And it's because insurance works ahead for the year ahead, and you have to pay in every month. So whenever the year comes up next year, there's enough money in there. So that's always one that's always kind of confusing. The next thing is lender fees. What I've kind of harped on a little bit in the other podcasts is that in section A, lender fees, that's the one section that pops up like, okay, there's an underwriting fee, origination fee. What are those things? And because they can vary from bank to lender. So those are the two areas that are the most that brings the most questions. And another thing I can hit on again, lender fees can always be negotiated. Like just because that you see a processing fee of $9.95 and origination fee of $11.95, whatever the case may be, those can be negotiated, and that typically comes with the variation of rate that you can take. And that what I was hitting on in another episode that can offset. So if you want the lowest rate, you will likely see an origination fee on there because that loan officer or lender, they have to charge for their time. So if you take 6% and that's the lowest rate available, likely we'll have full lender fees. Or, we give the option of say 6.25, and all of a sudden the processing fee and lender fee is credited. So those are ways to offset cost. And that's why I say everything is negotiable.
That's really good to know. So there was something that I experienced myself. The estimate of closing costs that you gave us seemed high. The realtor, our buyer's agent, was like, oh my goodness, they're so high. They
Yeah.
were high enough that our realtor and the other realtor were surprised by the number. Now, can you talk about why an estimate might be calculated on the high end? And how does that protect the borrower?
Okay. Well, the main reason that your initial loan estimate comes with me to be a little bit higher is because there are fees on every loan that may be charged because we can't go back and charge a fee that we don't disclose. So there might be a verification of employment fee on there that, says $68 or $168 for two borrowers. Um, if I don't put that on there, then we lose that money. And that's with every bank. So we put fees on there that could be charged. We don't know everything just yet initially. Like I don't know if there is going to be, if there is going to be a verification of employment fee, because that does not every employer charges that. Most of the time they don't, but we have to charge it just so we can at least recoup our cost whenever we pay for it up front for you. That's the main reason why because we can always take away. We can't add back after we disclose. So that's why every bank or lender comes back generally. I mean, if they're being responsible, just to be honest, I mean, we have to put those fees on there if they can be charged, and it's always a lot easier to take away. And one thing that I do with every borrower that I speak to is they'll see the initial loan estimate with their initial disclosures, and I'll say that there are gonna be fees on there. It's gonna look a little high, but I have my own with our mortgage software on the broker side of things that makes it a little bit easier to read and more realistic of what you can expect at the end. Just because I know I'm looking at one now and I'm just trying to give you an example. I know that there's not going to be a tax service fee on this particular loan, where you'll see say a $70 charge on there, but in the end, it won't be there in case there is. So it's just, we have to cover our tracks. We're not just trying to charge junk fees, as that was a big thing in the past before Dodd-Frank, back in 2009, 2010, before all the mortgage reconstruction happened. There were things called junk fees where mortgage companies and lenders were charging things that didn't exist. Like they were charging, for a credit report that costs $50, they charge 100. And you can't do that stuff. And that's where everything's regulated now. It's so much better. And but we have to disclose if there's a possibility of a fee, we have to disclose something there, because I mean nobody wants to lose money. But so it's always nice to be able to take those fees off, and that's what I do with my own personal loan estimate. With someone that I'm working with, I can show what a more realistic number at the end is going to be.
Very good to know. And thinking about those regulations, I'm going to circle back to something that you mentioned earlier on the appraisal, because there was something that you had talked to me about when it comes to appraisal and having that third party. You don't even know who that appraising company might turn out to be or who that
Right.
appraiser is. Could you talk a little bit about that? Because again, that's not something you can shop. It is on the closing cost. It's baked in, but it's part of that regulation you're talking about, right?
Yes, yes, that this all happened back in 2010, basically, and that's where we have to order the appraisal through an appraisal management company. I don't know who the appraiser is going to be. Back when I first started in this business, I developed relationships with appraisers. I could call them up and tell them the value that we need on the property, um, and just make the order, that way, like literally over the phone. Yeah, I'll send an email. And it was a lot easier. I still kind of sort of wish it was that way now, that I could have a relationship with an appraiser, but they've taken that away. And it's been this way for quite some time. So we order an appraisal and it goes through appraisal management company. We don't know who it's going to be until I don't know who it's going to be until I get the appraisal back. And then I see who the appraiser is and who did it. So we charge, like, as far as the cost, I don't know sometimes how much that particular appraiser is going to be. Some are set at 450, some are set at 550. I put on our loan estimate 650 because I know it's pretty much not going to be more than that. Sometimes an appraiser will charge more money if the property is more rural and where they have to drive and, trying to find comps. They're going to put more time. It's going to take them more time to put this appraisal together because of where the property is located. Sometimes they'll charge more, but generally not more than 650. So that's why I put basically the max on the loan estimate. And more times than not, it'll be $100 less than what it actually is, $150 less than what it actually is.
Very good to know. So let me ask about timing. How early in the process can someone get a real sense of what their closing costs will look like? Is there anything they can do earlier on to avoid being caught off guard later?
Yes. The thing to do is get your homeowner's insurance quote immediately. Like as soon as you have you're going to sign the line on a purchase agreement, or even before, get a homeowner's insurance quote on that particular house. Let the insurance company know what the sales price is. They'll look it up and they'll put a quote together for you. That I can't stress that enough. You also with the loan estimate, any loan officer, any good loan officer can put together a ballpark where I can estimate what your insurance is going to be because I see it. I see what it's going to be in the price range that you're looking at. The type of house that you're buying. I have a good idea where you should fall. So in the very beginning, you should have a very good understanding of like, okay, I'm going to need X amount of dollars. I try to be on the high end. If your total with down payment and if you're paying for closing costs or not, let's just say, your total is, I'm estimating is 15,000. What I'm trying to do is more than likely, I already know it's going to fall around 14. I try to be on the high side. That way there's no surprises at the end. And then as we go along, typically right after we get the title work back, and whenever we get title work back, that relays to us exactly what your property taxes are going to be, what they're going to be estimated to be with the new sales price. Because just because the home that you're buying is tax assessed for, let's just say, $1,500. I'm kind of stuck on $1,500 for some reason. So just say it's $1,500 that's a tax assessed now, but you're buying this home for 250,000. Once you get tax assessed again, those property taxes are going to go up. So what the title company does and what we do is we estimate what that number is going to be whenever your property is tax assessed again, because it'll happen typically within a year after you buy the house. So what we want to do is we want to prepare you to like we see that the property taxes right now are 1,500, but it's more than likely it's going to go to 2,000 whenever your home is tax assessed again. So we go off of that number, and that's why it's important whenever we get the title work back, we should have a very very close number to what you would be bringing to the table.
I want to talk about something that you mentioned in a previous episode about paying closing costs and who would be responsible for that. And you had made a request in another state where they were like, no, that's a hard no. We're not
Yeah.
paying for closing costs. What are there limitations? What might that look like with that negotiation? I know we're kind of going into that realtor side of things, but what might that look like in that negotiation? And what are there limits?
Okay, so the seller can cover closing costs, and they can on a conventional loan they can cover up to 3% of of whatever the sales price is. So if the sales price is 200,000, the seller can cover up to $6,000 for you on a conventional loan. Okay, and that can be financed into the loan. FHA is higher. You can go, I think, 6% with FHA government-backed loan. VA loans, I believe, are 3%. USDA, I think they're around 6% as well. But regardless, that happens more times than not. It is negotiated with the sales price, but it totally comes down to the area that you're buying. I have a gentleman right now in Lexington that he's been trying to buy. I've had him approved for pre-approved for over a year now, and he's finally got the house where his bid was accepted. This is the fourth time in the last 6 months, and the other three he got outbid or there was a cash buyer. In that particular gentleman's case, he could not ask for closing costs to be covered or negotiated in because, and it's in Lexington, Kentucky. So, and where he's looking is a very sought after area. And so, where the sellers, they're getting multiple offers. So you see an offer for 200,000, but you're being asked to cover $5,000 in closing costs, and then you get another someone else that's making an offer for 200,000, but they're not asking, but that buyer doesn't need your help with closing costs. Which one are they going to go with? They're going to go with, the 200,000 where they're not having to cover any closing costs for anybody. And that's 10 out of 10 times. You're not ever going to typically get a seller that'll go that direction of covering costs and, making, $5,000 less on their property. So it just depends on the area. It depends how in demand that particular home is. But it also depends on that realtor. The realtor needs to be a little savvy and understand, making that offer, how they can make that offer. If they come in and already incorporate closing costs. The good ones, the good realtors reach out to me before they make an offer. And they're just like, how much are closing costs roundabout? And I'll say 7,500, and that's all they need to know. So they know that if there's a chance, they already know to work that in to the offer. So that's what I like the most about whenever a realtor communicates with me is they already know that. That tells me that they know how to negotiate for you. So I think I got a little trailed off a little bit on my answer there, but that's what I like about realtors, and as far as whenever they go and negotiate the sales price.
So we've kind of covered this, I think, but your estimate and what someone actually pays at closing, you talked about the difference, but I want to make sure our listeners are very clear where that difference comes from as we kind of wrap up this conversation. The estimate's real high, closing is maybe different. Where are they looking? What section, what line items are they looking at that changed between the estimate and what the closing document actually states?
Okay, so there's a couple things that happens during the process. Whenever the loan officer locks your rate, there is no more negotiation. Essentially, that means what the closing costs are. They are what they are. If you have lender fees, that's where they are. When they lock the rate, it's pretty much it for the most part. But again, everything's negotiable. But let's just for our circumstances of this conversation, when they lock the rate, that's whenever closing costs really start getting a little bit more steady, and the negotiation kind of stops. This is what it is. When the rate is locked, you'll get an email and you'll be notified. You'll have to sign it. You'll have to see that that you have that the rate has been locked, and this is, and if there's a cost, and if the loan estimate has changed. So along the way, you're going to be updated with if any cost has been changed, and typically that happens when the rate is locked. Um, so before you get to the closing table, there should be no surprises. Really, I mean, once we get title work back and we have everything together, there should be no surprises whatsoever. The only thing that can change at the end is the day that you close, because closing costs are going to be different by the day you close. It's going to be different if you close on the 20th. They're going to be X amount. If you close on the 25th, they're going to be X amount. It's not going to be the same. So that's why it's kind of a moving target. That's the challenge that we have as a loan officer and estimating and all this kind of stuff. So um, odd days interest is a thing. That's why it varies. And odd days interest is just basically your daily interest on the mortgage that you're getting. And let's just say you close on the 25th and there's 30 days in the month, you have 5 days of interest that you have to pay upfront. That's part of your closing costs. So closing at the end of the month is much cheaper. It's way more ideal to close at the end of the month for the buyer than it is at the beginning, because then you've got a full month of interest that you'll have to pay as part of closing costs. So
Nice little tidbit for people to leave with today. Jay, I think this is one of those moments that almost everyone who's bought a home has experienced. Looking at that number and feeling like no one really walked them through it ahead of time. I think you do. But maybe there are still some surprises. Next time, we're talking about something that catches a lot of buyers off guard, condo mortgages. If you've ever assumed that buying a condo works just like buying a house, Jay is going to walk us through why that's not quite true and what to ask before you fall in love with a place that might come with more complications than you expect, and especially if there's an HOA. If this conversation gave you a clearer sense of what to expect or what to ask the next time you're in this position, that's exactly what this show is for. If you found this conversation useful, share it with someone who might need it, someone getting ready to close on a home, or someone who's been through it and still has questions about that final number. We'll leave it there for today. Someone had to ask, so I did.